Our next presenter is Michael Weber. He will be talking about information and macroeconomic expectations, global evidence.
Well, thanks a lot, Damjan, and thanks a lot to the organizers for putting our paper on the program. It's always a great pleasure to be here at the ECB at the joint conference with the Cleveland Fed. And so, what I want to do is talk about some ongoing work we've been doing with Francesco at Georgetown. And now, at this audience here, I don't need to motivate that, but here I just have two quotes from two policymakers on the two sides of the Atlantic. What we thought is actually quite interesting, if you actually follow up a little bit on the speech of Jay Powell, he keeps emphasizing that he cares a lot about the expectations of households rather than maybe looking at financial market participants. Maybe to follow up on what Guido was saying, even as a macroeconomist, you might care about households because they might ultimately represent 2/3 of GDP, at least in the US. Now, why would you potentially care? It's also a policymaker. So imagine now you set a homogeneous policy rate for everyone here in the room, but for whichever reason, and Christiane showed it to us this morning already, there's lots of dispersion in 1 year ahead inflation expectations. This would actually transmit into heterogeneity in perceived real interest rate, then which via a consumer Euler equation matters for consumption savings behavior, matters for whether I buy a house, whether I take out a mortgage, which type of mortgage I take out, could even actually matter for stock market participation. Now, thanks to the great work that the ECB is doing with the wage tracker, and I look here at Sarah, it's also, of course, a concern potentially wage price spirals being triggered by inflation expectations. Even normally, if you're kind of in times like now, you oftentimes assume inflation expectations are well anchored, so you move around kind of policy rates that then should transmit into movements in real interest rates, and all those things should be going on. In unconventional times, when you cannot move around policy rates to the extent they're stuck at a lower bound, you can potentially move inflation expectations via communication. Again, it potentially shift people's action. Now, if you look actually at the micro data, what's a little bit maybe sometimes worrisome, you tend to see, and this is kind of where the title of that paper comes from. In 23, we studied homogeneously inflation expectations across 47 countries around the globe. So everything that is non-white is the country that we serve. And there's just tremendous variation in average 1 year ahead inflation expectations. Now, naturally, you would say, well, look, Michael, if you look and compare maybe Brazil to Germany, of course, naturally, there's differences in average 1 year expected inflation, or Turkey and France, just given that the economic environment in these countries is very different. Yet, what you also see is that independent of which country you pick, on average, compared to ex-post outcomes, you see an upward bias on average across all countries. Of course, the upward bias varies across countries. And so what we now want to do a little bit try to understand, is there a way to a little bit make sense of why people on average have upward bias expectations? This is not just averages across countries. Another thing that came up in Christiane's keynote presentation is this kind of systematic variation across socio-demographics. What I'm showing you here, some going back to the work of Joning for Swedish households in 82, you tend to see that women have higher inflation expectations than men, was then shown also in the US and other countries. Here, what you see, if you request 1 year inflation expectations on a gender dummy, you can also take out kind of country fixed effects, or you can take out, when you pool it, here's country by country, you can take out financial literacy, education, and these type of things. By and large, among most countries that we surveyed, women have higher inflation expectations than men. There are 4 countries where you see the opposite phenomenon. You might give it to me that maybe those countries are special. It's Argentina, Turkey, Zimbabwe, and Egypt. And, I don't want to now single in on specific countries, but maybe you are kind of open to the interpretation that these 4 countries are special. Now, kind of to set the stage for some of the questions that we brought to the field into 2023, I want to a little bit motivate based on what we did previously and what we found to kind of appreciate. Maybe it's not that we randomly kind of came up with asking certain questions, going back to this gender dummy and inflation expectations. at some point, like I was just a first-year assistant professor in Chicago, and Anil Kashyap, who many of you know, completely derailed my first paper I ever wrote on inflation expectations. All my colleagues thought I'm a moron because Anil is the expert, and he completely derailed my talk. Afterwards, Anil told me, well, Michael, it was an excellent presentation. So, okay. But, unless you can explain to me why women have higher inflation expectations than men, I don't think you should work on this topic. Okay, so we went back to the data. We fielded our own survey. It was the first time we worked with a Nielsen HomeScan panel. What is really, really nice with the Nielsen HomeScan panel, given it's such a large cross-section, you can actually survey many people, but crucially also you can survey at the same time male and female head of the same household, meaning you can absorb many determinants of inflation expectations that typically vary across survey participants: housing choice, family structure, household income. Because in our case, we kind of look within household. Is it the case that there's a gap in female versus male household heads inflation expectations? That's what you see on average across 10,000 households in the left bar. Within household, women expect about 0.4, 0.45 percentage point higher inflation expectations than men. Then you move to the middle bar. What we do here, we simply look at a subsample of survey households where the male household head in the survey declares to never partake in grocery chores. And you see this gap increases by 40 to 50%. And the far right bar, that's a admittedly small sample of roughly a third of our overall sample households, where the male household head declares at least once in a while, I walk down the aisle at the Rewe, I see the price of milk and butter and maybe the price of beer fluctuating over time. And in those households, men have equally high inflation expectations than women. And that's why the difference between the two is economically and statistically zero. So like exposure to volatile price changes, while grocery shopping potentially might be relevant. And so like, just kind of like to then motivate a little bit the framing of the paper, what we try to understand is kind of how to make sense of these patterns. So clearly, like, it's almost like a dead horse. Can fire explain this pattern? Obviously, no. Is rational inattention potentially fully consistent, at least the standard formulation? Can, of course, explain to us like time variation, accuracy, and also dispersion in the cross-section. A persistent upward bias maybe is less consistent with a standard formulation. And then the question is like, what potentially should we add to such a framework to make it fully consistent with what we see in the data? And that's kind of like a little bit the attempt to zoom out from a single country setting globally to understand what are robust features of the data, or saying it differently, what's worthwhile to shed the light on to potentially then spend efforts making sense of that theoretically. So now what is our kind of like, lens through which we looked at that? So like in April of 2023, together with Morning Consult, it has done amazing work also with the Cleveland Fed, we were fielding a homogenized survey in 47 countries that represent roughly 90% of the world population and the world GDP. We, in the kind of fall of 2022, designed the survey. Then Morning Consult fielded it in January on a pilot version in 5 countries. They then went ahead and translated it across all the countries. And then in April, it went to the field. And as I mentioned, like we want to understand like what are kind of features that robustly show up. So like we already saw, lots of dispersion across and within countries. Generically, there's an upward bias relative to exposed realization. And like also already a little bit, we saw that there's some sorts of demographics that systematically are related to differences in inflation expectation. We want to kind of a little bit understand why do those sorts of demographics relate to inflation expectations. Now, what I want to actually argue now in the next 15, 20 minutes, that this has nothing to do with gender, has nothing to do necessarily with high and low income, but largely it is due to people consuming different sources of information. Like I kind of like, might go to the newsstand and read the Bild-Zeitung, whereas maybe Damjan reads the FAZ, because we have differences in coverage of a certain topic in different media outlets. That's could potentially drive differences of our inflation expectation. Now, unfortunately, I might know the different quality of news outlets in Germany. I don't know that globally. So unfortunately, we don't go into that granularity, but it will be like, local information sources, like, walking down the aisle grocery shopping versus aggregate information sources, newspaper or TV. And so like what I would actually want to kind of show you, if I rely on local information sources, this is consistent with rational inattention, I do actually acquire more information when it's potentially more costly to be uninformed. But given that those local information sources might not give me a representative signal of prices, I might actually, when I consume more information, in fact, become more biased. And then what I should actually show you, that demographics relate to inflation expectations because they relate to which information sources I consume, but conditional on the information source, they barely matter for inflation expectations. So I do say women and men on average have different expectations, but not because they process information differently, largely, however, because they consume different information sources when they form expectations. And then like at the very end, I want to zoom out and understand, like, why do people consume different information sources? Will then be a cross-country analysis. And here we want to actually argue that it's kind of trust in the producers of aggregate information, the government and central banks. Like, famously think about the case of Argentina. If I have a high inflation environment, maybe the producers of aggregate information have incentives to fudge the data. I then actually have less trust in those institutions. And that's where ultimately I walk down the aisle and look at the supermarket prices. That potentially can actually help us understand the sorting into information sources. Now, what I want to do is actually first kind of like, come up with a classification of information sources, where we want to then elicit whether people actually rely on these sources in forming aggregate expectations. Like the first one is signals in my daily life. Similar to like a Luke and Islands model, I focus what's happening around me, talk to family and friends, co-workers, or maybe shopping activities. Social media is a little bit kind of like unclear. So Michael has this nice paper that, oftentimes like I focus on what other people are retweeting, but maybe I also follow what maybe at ECB is tweeting. The difference, however, from a Lucas world is that potentially when I kind of source from those local information sources, I might not get an unbiased signal about the aggregate price. And what I mean by that, this came also out in the panel by Dave earlier. And so like, this is based also on some previous work, so where we use the scanner data and then create at the individual level a measure of realized inflation, meaning that's crucial, individual bundles and individual prices paid. You create at the individual household level kind of Chandler's pair price index, and then you bin people based on own realized inflation in the past 12 months, and you just collapse and look at their 1 year ahead overall CPI inflation expectations. You do see that people expect higher overall inflation when higher inflation is realized over the last 12 months in their own bundle. What you don't see here is, in fact, people tend to focus or weigh more good price changes that actually they purchase frequently rather than based on expenditure share, and price increases relative to price cuts. And so like this is why we wanted to elicit local information sources. And then alternatively, you can think about aggregate information sources. So here, newspaper, central bank reports, TV, and so on. And so now the first thing I want to show you, based on like those 47,000 respondents, what do they on average state when you ask them, earlier you told us you expect inflation to be 7%. How important were the different information sources for you thinking about inflation? Like the information sources were provided in a randomized fashion so that there's no ranking effects or anything. And so like if you focus now on dark and light blue, very important or somewhat important information sources that were not mutually exclusive. You do see across all of those survey participants, it seems like, local economy sources, energy bills, shopping experiences seem to be potentially the most important one. People also read government reports, but maybe to a lesser extent. Then you could say, well, maybe if I'm, living in Germany, I trust the government, I trust the ECB. For me, kind of reading those newspaper articles too costly. I just kind of check out what's happening at, let's say Kaufland. I'm not getting paid by Rewe. So like, maybe that's kind of normal. And indeed, you do see, if you now focus on a sample of countries that have below median realized inflation, either in the 10 years or 20 years prior to our survey, you can also look at the below median inflation volatility. You see, like, countries like Germany, Japan, or Switzerland, again, like, energy bills and shopping experiences are the most prevalent mentioned information source. But if anything, in countries that had above median inflation or inflation volatility, like, all information sources become more important, but especially, again, local information sources. So like, indeed, if I live in Brazil, Turkey, or maybe Argentina, when it's maybe more costly to be uninformed, I do state information is more important, but it's still my local information sources that predominantly I consider as most important. Now you could say, well, maybe that's cheap talk. People just state in the survey that they consider like newspapers less important than supermarkets. Let's actually see, and again, like, this is purely survey-based, purely correlation. So like, you might disregard anything I say as kind of not interesting or purely correlational, but let's actually just understand whether kind of like what they previously stated in terms of 1 year inflation expectations matters then in terms of like being determined afterwards by the information sources they mentioned. So we don't ask information sources first to make them salient and then ask for expectations. We first have expectations, and subsequent, after a couple of questions, we ask for information sources. And so the regression we run here is 1 year ahead inflation expectations on like a dummy variable that equals 1, important or very important, given information source, zero otherwise. That's pooled here, so we have country fixed effects in there. And then you throw as many sorts of demographics at that specification as you like. Income, age, age squared, kind of education, gender, family status, housing choice, and so on. And what you robustly see in that regression is that if I state, I love to read government reports to think about inflation expectations, you have like by about 3 percentage points lower 1 year ahead inflation expectations relative to someone who doesn't state that. Instead, if you state like, I look at my energy bills for inflation expectations, you have roughly 2 percentage point higher inflation expectations relative to someone that doesn't state they look at energy bills. And this is, again, within country by adding country fixed effects and saturating with all the type of sorts of demographics that we elicit. Now you could say, well, why do you look at aggregate results if you actually have country by country evidence? And that's what I show you here. Now what we do, we standardize inflation expectations at the country level. We then use standardized 1 year ahead inflation expectation, regress it on source dummies, and again, sorts of demographics. And you see, like, across most countries in the top row, if you adhere to aggregate information sources, you have lower 1 year ahead inflation expectations. If you focus on local information sources, you have higher 1 year ahead inflation expectations. And so, like, why does it actually kind of result in higher inflation expectations? Because if you read the newspaper, you just think that inflation right now is lower. And then we know from going back to Jonung, perceptions tend to be the strongest correlate of expectations. If I think current inflation is lower, I also expect inflation going forward will be lower. And similarly, if I look at my energy bills, I think that inflation is higher than what it actually is. And that's why I form higher 1 year inflation expectations. Now, the title is about macroeconomic expectations, not about inflation expectations. So therefore, I also want to show you briefly that similar patterns hold if you focus on the left house price expectations, on the right interest rate expectations. But for the rest of the talk, I want to focus now on inflation expectations. You could say, well, look, of course, information choice is highly endogenous. I'm totally agreeing with you. One way to potentially get a little bit closer to causality is to exploit an intensive margin. So for like grocery exposure and gas price exposure, we elicited within the survey how often people go grocery shopping and how often they pass by the gas station. And again, of course, depends also where you live, whether you go shopping at kind of a, I don't know, Target versus Whole Foods and so on. Again, so like, I don't want to kind of push that too far, but you do also see more frequent exposure, both along the grocery domain and the gasoline domain, also results in higher kind of forecast errors for inflation in both of the panels. Now, coming back to how I started out with, like, and this goes back to our discussion throughout the day already. We have like this evidence across decades now that there are some sorts of demographics that reliably correlate with 1-year inflation expectations. Now we want to understand, like, on the global scale, what can potentially help us understand why certain sets of demographics differ in their inflation expectations. I remember, like, last, I think, October, and when Anna Maria Lusardi gave her keynote speech, I think at the joint ECB conference with the New York Fed and the Bank of Canada, she actually made convincingly the point that financial literacy would be really important also for central banking. And so that's why we also had focused actually in, like, how literate or financial illiterate different countries on average are. And now what we want to see is kind of like, can those different variables help us understand why we actually consume different information sources? And so, like, what I want to show you now is, like, it is true that unconditionally in country by country, if you have a college degree, you have lower 1-year inflation expectations than if you have no college degree. But conditional on which information sources you use, there's pretty much no difference whether or not you have a college degree. So let me say that again. College matters for whether you say, I read the newspaper or government reports versus I look at my energy bills or my shopping experiences. But fixing newspapers, and this is what you see, the far left bar for college and the far left bar for less than college. If you read newspapers, independent of whether or not you have a college degree, you have lower inflation expectations instead, independent or not whether you have a college degree. If you state you look at energy bills, you have higher inflation expectations. It is the sorting that matters, not the processing of information. Now, just briefly flip through a couple of those pictures. The same if you have economics degree or not, if you are above or below median age. Now, I wanted to say older or younger, but now I'm also almost old, so I don't want to say that anymore. Like, whether you're male or female doesn't matter, whether kind of like, any of the other things I had like on the graph. And so now what I want to do is kind of zoom out and look at cross-country evidence to a little bit understand what potentially might help us understand the sorting. And so, like, here, just to give an idea, there's lots of variation of whether people state I look at local versus aggregate information sources. And so, like, what we kind of like argue is really important is kind of like the trust people state in like governments and central banks. We had kind of a battery of trust questions, also trust in commercial banks, international institutions, and so on. What I'm showing you here is a principal component of trust in governments and central banks, just because they were so highly correlated. You keep constant trust in other institutions. And what you see here, and like, at first you might say, well, this is a little bit of a tautology, but then, I think it's actually quite meaningful. If you state that you have trust in central banks and the governments of your country, you kind of are way more likely, country by country, to read newspapers, to get news about inflation, to focus on TV shows, get news about inflation. Of course, also government reports. Instead, it's unrelated of whether or not you kind of look at kind of grocery prices or energy bills. So like, like the way I think at least about these correlations is naturally if I live in a country that had a history of high and volatile inflation, and that's of course also like quite concerning, like right now in the US, at some point I might lose trust in the producers of those aggregate statistics. I might no longer, I'm sorry to now say something negative about the BLS, given that we have colleagues at the BLS here in the audience, but I might no longer trust the statistics of the BLS, and instead might actually, and this is actually why the Billion Price Project came about, I might actually try to maybe get alternative data sources. And that's kind of what you see here. If like people do have high trust, they indeed actually rely on official sources, they have lower expectations. Instead, like, if you don't kind of like trust the producers, naturally you will not actually read government reports. And so, like, coming back to like the motivation at the beginning, like, at least the way I think about it right now is like, what you would need to do, like people do kind of get more information when they live in a setting that is more volatile and where inflation is higher. But of course, endogenously in these settings, you might also, at least over the medium run, lose trust in the producers of aggregate information. And so therefore, like, potentially what, like, the way to extend the standard rational inattention model is like to allow for the information sources to not be biased or representative of the overall price, as Lucas says. And like more generally, I think, our findings potentially also shed light on the importance of building trust by institutions. And, of course, like was already alluding to, like right now, it's of course, at least from a research perspective, a really exciting time where you can see how potentially undermining trust in institutions could potentially also result in unanchored expectations and all the ramifications we were discussing earlier. Thank you.
Thank you, Michael. The discussant will be Fiorella de Fiore.
Thanks so much to the organizers for having me to discuss this great paper. It was really exciting to read. So what the paper does is to relate to two robust findings in the literature on consumers' belief, the large dispersion of macroeconomic expectations and a persistent bias across consumers over time. The evidence is typically drawn from a single country type of data sets. And so the paper here today asks three types of questions. Is dispersion robust to an homogeneous elicitation of beliefs at the global level? Are there common drivers at the global level of this systematic bias that we observe in expectations? And can mainstream models explain the evidence? So what the paper does is builds this impressive global survey for consumers' expectations and perceptions covering 47 countries. And there are lots of findings, as Michael was showing. I will summarize it in two main ones. The first is that households' macroeconomic perceptions are consistently upward biased. And the bias is heterogeneous across countries and is also larger for consumers that tends to acquire information from local sources. The paper also provides evidence on the information acquisition of consumers and their update of beliefs. And what it finds is that consumers in countries with higher inflation try to acquire more information, but they also make larger errors because they tend to draw more on local information sources. And rational attention models predict something else. So they do predict that higher inflation should lead consumers to collect more information, but they also predict that the bias should decrease over time as more information is acquired. And so the reasons for the discrepancy between theory and evidence is a neglect for trust and for the quality of information in this kind of models. So my discussion will have two comments on the general results of the paper and one on the ability of rational inattention models to explain the evidence of this paper. So the first comment is about the classification of information sources into aggregate versus local, which is inherently a bit imprecise, and that's because, of course, you can think of social media that here are labeled as local type of information sources, as reporting as much aggregate as local information, depending on the reader and on the type of social media. You can think of work-related activities that are here labeled as local, as generating aggregate information for professional use. Or you can think of newspapers and TV that here are labeled as an aggregate source of information, as having also local newspapers or TV channels that focus much more on local type of information provision. And so I wonder whether this type of difficulties in the classification can lead to strengthen the link between local sources of information and high expectations and biases, and vice versa for aggregate sources of information and low expectations. The second comment is about the take of the paper that low trust induces agents to use local information sources, which send less accurate signals about the aggregate economy and therefore are more prone to perceptions errors. And here, this finding is based on various pieces of evidence in the paper. I cannot all show, but let me summarize them as being, for instance, the fact that there is a positive relation between higher past inflation and the use of all sources of information except the official reports, which the authors take as hinting at a loss of trust in governments after periods of high inflation. A second type of finding is that the trust in government and central banks correlates positively with the willingness to use official reports. So if you think that the country has been characterized by high inflation in the past and today there is a lower trust, you will tend to see that that country, consumers in that country tend to read less official reports. And so the issue is that the evidence also points to a positive correlation between trust and all other sources of information, which to me point to a lack of reallocation of attention of consumers from aggregate to local sources of information. And this may matter because reducing information acquisition from official sources without replacing it with larger use of local sources may not be conducive to a higher bias. And indeed, the results suggest that there is a limited role of the level of trust, whether high or low, in affecting the relation between the sources of information and the biases in expectations, which is what this figure shows, that there are differences in coefficients, most of the time not very large, but in particular, it doesn't seem that they are significant, but something to be checked. The last comment is about the role of rational attention models and whether they can account for some of this evidence. There are the typical rational attention model postulates that the cost of information acquisition depends on the learning of agents, and in particular that the costs are a function of the entropy reduction or of the remaining uncertainty after observing a signal from the information source. And this is reasonable when agents are sure about the amount of information they can extract from a source. But there is an alternative type of model that model cost of information acquisition as a function of the total source capacity. So, basically, they postulate that the costs are a function of the maximum amount of entropy reduction of an information source. Think of, for instance, a broadcast where you need to pay to get access to the information, but you don't know exactly what information you will be able to gain as novel information. So maybe 90% of what the broadcast give is something you know already. Only 10% is new, but you need to pay for the entire amount of information produced. And so this latter class of model can, I think, generate endogenous choice of the information source and also persistent errors that are more in line with the evidence of this survey. So let me quickly give you an example of how this type of models can reconcile with the evidence, largely based on an example given by Nimark and Sundaresan. So here, think of a state, omega, think of it as inflation, taking two values, 0 and 1, and the signal S that also takes the value of 0 and 1. And an agent's prior belief that inflation will be high with probability pi. And then define an information channel capital S, by the error probabilities of the signal that this channel can produce, S. And then entropy here, or the expected information about the state variable omega, is given by this function omega that depends on the priors on the state. And so you can think of two concepts: revealed information, I, that is the amount of information you can get after observing a signal, and another concept that is channel capacity. So this is the maximum amount of information that a channel or an information source can release across all the possible priors of agents. And so these two concepts lead to alternative definition of the cost of acquiring information. One, gamma I, is a shear theta of the amount of the information released, I. And the other one is the cost gamma C, that is a fraction theta of the maximum amount of information that can be released by a certain information source. And here, the information released is given by the expression. What matters here is that the more precise the signal is, or the less informative the signal, the closer to 1 is this, the closer to 0 is the log, meaning that the information released by this channel tends to be low. And so depending on how you model the cost, you can have very different implications, because if you model through cost of acquired information, the value, the cost of this information when the prior is very precise goes to 0, while if you model it as a cost of channel capacity, it remains independent of this prior. And so the implication is that if you have this cost of acquired information and the priors are very precise, this decreases the value and the cost of these new signals. And so agents, they keep acquiring information and updating their beliefs until the prior is equal to the posterior. But if you model is at this cost of channel capacity, then the value of an information when the prior is very precise is low, but the cost doesn't change. And so agents decide not to acquire very expensive signals and not to update their beliefs. And so this model create a confirmation effect where agents can choose channels that are more likely to confirm their priors. And so these lead to beliefs that come out of random signals, but become self-fulfilling, and they lead to permanent clustering. So how does this explain the survey results? Imagine that there is an agent that has low inflation expectations, randomly get into an official source that tell him that inflation is low. Then if the prior is precise enough, this agent will choose to keep sourcing from the official report and will stop updating beliefs. And the same will happen to agents with high inflation expectation, meaning that there will be clustering of beliefs in very different levels of high and low inflation and high and low biases. Let me conclude here because I think I'm out of time, but great paper.
Thank you very much, Fiorella. I will collect a few questions from the floor. Yes.
Thank you. Striking results, Michael. No, I was just wondering about the interpretation. So do I understand correct? So you feel this one particular point in time, no? So I was wondering, is it correct to take away that, okay, we observe the sensitivity of expectations to local information, but the bias that you showed could be just specifically dependent on that particular point in time where you fielded the survey?
Other questions? If not, I'll let Michael respond to the discussion and this question, and perhaps we'll have some more questions.
Yeah, so like you're totally right that indeed, like, this is from a one-off survey. Now, you do see similar patterns in terms of like how consumers react to information sources in different inflation environments. This is where the cross-country comparison actually comes in handy. But ideally, you you would also want to see within country over time. Like, there has been a little bit of work doing that also, but I think, this is now an excellent opportunity to kind of advertise kind of like some work we are doing in collaboration with colleagues at the BIS, and in particular Fiorella also here. So we had actually another wave of global surveys in the field earlier this year, and we were just earlier in the coffee break discussing like redoing that with kind of like a special add-on modules also next year again. So hopefully kind of like in one of the future iterations of the conference, I can give you a more informed answer relative to what I was just saying. So like I also briefly want to kind of like take the opportunity, and thank you a lot, Fiorella, to kind of like for the great discussion. And, I'm definitely totally with you that, some of the distinction in terms of local versus aggregate information sources are less sharp than, ideally we would want to do that. As I alluded to, like if you do a single country study, I would also, even with the newspaper, want to kind of stratify a little bit, based on Michael's finding. Also, Twitter is somewhat ambiguous. I'm totally with you. Now, similar for high and low trust, I think it matters mainly for the sorting, and then conditional the sorting. It's like not that important anymore. And actually, like, yeah, need to look a little bit more into the paper by Chris Niermagen you mentioned. And so, like, at least as far as I understood it, it couldn't explain persistent biases and clusters. I'm not totally sure I've followed completely. That would actually help us will fully explain, but I think, you said like can partially explain. I think that's potentially it. Why in high inflation countries, people are more likely to sort into local information sources and then have a higher bias, but I need to go back to that paper. Thank you so much, Fiorella.
We have another question.
Thanks. Super interesting presentation, and also Discussant's comments. Michael, I guess one thing we're trying to do at the Bank of England is move into different communication channels. I believe I'm going to be doing my first interview with an influencer very soon, and I know a lot of others are using these routes, and we've started to use it with things like banknotes and more sort of tangible things, and now we're branching out into trying to condition inflation expectations. But how I can't remember from your slides, but they looked quite conventional channels that you had, and I guess it's a version of Fiorella's point in a way, as channels become more blurred. Or one of her points, as channels become more blurred, because I mean your results are really striking, and I just wonder, as everything, the media world just becomes more, the reception for our messages becomes more and more diverse and dispersed. And I guess what you think of that, but then I guess I'd be interested in any views on whether these efforts. I mean, I must admit, I go around my local shops in London, and I'm sure I'm slightly influenced, even though I am a rate setter. Sorry, I'm not sure if there are any media, but you have to sort of sort through all your sources and then deal with any biases. But I'd be interested in any views on that kind of direction that central banks comms are taking, in terms of going down the social media and even the influencer route. And I'll stop there.
Damjan, how much time do I have?
Ooh, I'll give you 4 minutes.
Okay, perfect. Like, I think that's a super interesting question and initiative. And like, let me maybe just take a little slight detour. So like, when I remember, it must have been maybe May 2019, I was presenting an early version of the paper with Korbjorn Gornichenko in Central Bank Communication at the ECB. I remember there were many comms people, and like they afterwards kind of said, yeah, we already use social media for communication. And like, in particular Twitter. And so like, I remember I was asking, what's kind of like the Twitter handle you're using? It was @ECB. Now, the issue is that, people, when they use social media, most people, like normal people, not us here, we are anyway, like they don't actually follow institutions, they follow people. Now, they might also not necessarily follow a central bank governor, they follow people they care about. And so, like, I remember at the time I got a haircut in Chicago, and I was asking my hairdresser whether kind of like she would care if LeBron James would actually rap about inflation. And she said, well, look, whatever LeBron talks about, I'm interested in. And the background was that at some point, I remember the Cleveland Fed with a former president was considering kind of like doing a little bit of a US version of the Central Bank of Jamaica had done. My understanding is that the lawyers, after all, came and kind of intervened there. But so, like, to kind of like cut it short here, I do think, like, to the extent you can speak the language, or someone kind of can take your words, communicate it, or translate into a language that ordinary people care about, and you borrow the visibility and, I guess, kind of reach of someone who is an influencer. I can definitely see, I haven't seen like academic work on that, but at least putting those different pieces together, that potentially could be quite kind of powerful. And I could go back, but maybe to the Lego videos of the Cleveland Fed, but that's a different topic. And maybe we can discuss that at dinner.